Good morning. Good morning. How are y'all doing? If you're here in Tampa, we got a rainy morning.
It's raining outside.
You've got raining, Miss, because you're still in Tampa, right, Miss Pham?
Yeah.
Yeah, I know Taylor is also. And but just a day to focus on work. Today's our last day of class. Kind of emotional about it. I'm sure y'all always do. Get this way the last day of class because I so enjoy being in the classroom. We got a different type of classroom this second half of the semester. So how are y'all doing with just all schoolwork, just combined? I mean, this class with ending up in your exams, and are they a bunch of projects right now, or things kind of evened out, so that you don't have a whole bunch to do on any one particular day? Or
I think your exam is the only exam that I complete, which is good.
what, the only exam? I'm sorry, my volume is this is the only final exam you have?
Yeah, because it's optional, because it's like only 3 exams for like stats, and then one is just a project, and then one took out their exams and moved them to quizzes. So that's what we've been doing with that.
Okay.
So I have plenty of time to focus on accounting.
Good. Plenty of time to focus on accounting and your major, right?
Yeah.
So,
I've just got an exam today, and then I think until accounting.
Oh, well, good. So that you've got time. And with it being your major, this, in case you haven't heard in the, among your accounting colleagues, the other accounting majors, intermediate 1 is a critical, gateway class into the accounting major. It's honestly, it's where you figure out whether accounting is your major or not. This intermediate class. So I know, boy, it's you think about where you were in the beginning of the semester with just trying to even remember journal entries and adjusting journal entries, into now how we've gotten into some, very detailed work. So what I would like, we're going to finish chapter 11 today. And based on what we have left to cover, I anticipate that we'll have some time for any questions that you have, over the 8, 9, 10, and 11, the 4 that are on the final exam. Let's see, y'all's exam is on Thursday at 8:30 in the morning, right? Is that that's what I have? Is it on the final exam schedule? Is it Thursday at 8:30?
Yeah.
Okay, and so on Wednesday, I will be sending out a link today or tomorrow. I will send out the link for the office hours that we will have on Wednesday, the day before the quiz. And when most of the students are in the class, I'd like to get a general consensus of what is the best time of day, for y'all. I don't know, like if you've got other exams, Wednesday. Anyway, just to come up with what is a better time of day to have y'all's open office hours, come and go and ask questions. So be thinking about that, or looking at your calendars to see on May 6th. We know Taylor's open. She doesn't have any exams, but that day. But you know, of what time of the day would be best. So if you can take a look at your calendar and did it. Erin, you did a great job on Student Research Day.
Thank you.
Yeah, I was real impressed. I've been on that committee for a few years, and it's always so good to see, you know, the students and, you know, learning how to do research, and then, you know, presenting research, and, you know, when you get questions from the judges about being able to defend it. So did a really good job.
Thanks. I enjoyed it.
I'm glad that you did. So how are we doing? Let's see, we got, I'll give a couple of more minutes before we get started with chapter 9. Chapter 9, I was just working on, I've been up since I got up at 5:30 this morning, couldn't go back to sleep. So I've been working on y'all's final exam, and I continued, you know, working on it this morning to see how in Connect, you know, the questions are worded versus the way that I word it, to make sure that there's not any disconnects. And so far, so good. What I'm going to do is, I've got the topical coverage that I had given you. Good morning, handsome. The topical coverage, and so I want to look at, of course, focus in on chapter 11 to make sure that we have covered everything in chapter 11, and if we've already covered it, what questions that you may have before we get into the new material. The revaluation that IFRS has for long-term assets, as well as looking at the impairment rules, both US GAAP and IFRS, for impairment on assets that are depreciated, you know, like your property, plant, and equipment, and then assets that are not depreciated, like your intangible assets that have an indefinite life. And so there were two sets of impairment rules, and then there were US GAAP and IFRS under both of those. I've had some questions from students that in the Connect homework, I sent out the announcement that I moved the chapter 11 Connect to be due at 8 o'clock tomorrow, so that we've got the discussion of today for you to do the chapter 11 Connect. Although usually we do have it due this day so that you've got some exposure to the material that we're covering today. But one of the things that I've gotten a couple of questions on is there's a question in your chapter 11 Connect about impairment, and there's one, it's the same company, but it says do impairment under US GAAP and then do impairment under IFRS. And some students are saying, I know my number's correct, but I can't, Connect keeps marking it wrong. Well, you need to read the instructions. You just need to put a minus sign in front of it, because it's a negative number, because you're reducing it. So the solution is simple as just put a minus sign in front of it, and then your answer will be, if you got the correct number, your answer will be correct. Because I've got, like I said, students are saying, I know my number's correct, but it's being marked wrong. And just put a minus sign in front and you'll be good. So I don't know if did some of y'all run into that on that or if you've started your Chapter 11 Connect, just make a note of that when you get to that question. And the instructions say, to put a minus sign in front of it, but I've had, more than 2 or 3 questions about that. So I wanted to call that to your attention so that if you got it wrong, you can correct it now, or if you haven't started it yet, you don't run into that problem. Okay. So with respect to what we've already covered in Chapter 11, we went over depreciation, the straight line method, and the units of activity method. And you understand what the terminology is, what is the depreciable base, what is book value. The depreciable base and allocation base are the same thing. That is the amount that we're going to depreciate. Remember that we cannot depreciate below book value, below the residual value. I typed this in those words, when I was talking and I was writing it in the Word document, because I know that you encounter this in the Chapter 11 Connect, that in units of activity, if they say they had estimated that it would last for a truck that would last for 100 miles. And so they're calculated their cost per mile for depreciation using the 100,000 miles. Well, if they end up using the truck 110,000 miles, then in the last year, you won't be able to take all of the depreciation. You can't multiply the 110,000 miles by the per unit cost, because the maximum amount of depreciation that you can take in the last year is what does it take to get book value to equal residual value. Okay, remember, we can never depreciate where the book value is lower than the residual value. Another way of saying that is that accumulated depreciation cannot be higher than the depreciable base or the allocation base. Okay, so be careful about that, because you can run into that using the units of activity method. You could also run into it for sure in DDB, but we're not covering DDB, so you won't see that on the exam. Don't forget about partial year depreciation in the year of acquisition and in the year of disposition, that you can only take partial year depreciation. Make sure that you're paying attention to the dates that assets were acquired or that the date that it was sold. We have also gone over the journal entries for when we sell an asset, when we exchange an asset, and when we retire an asset. Remember the 4 steps that are in the note page that I gave you for, how on disposal of long-term assets. I also reminded you about the 4 steps in the topical coverage for doing the journal entries for disposal of the asset. For calculating the gain and the loss, remember that when we sell it, we're comparing the book value to the selling price. When we exchange it, we're comparing the book value to the fair value of the asset that we're giving up. That's like the fair value of the asset that we're giving up. And of course, when we retire it, we're not getting anything, and we will never have a gain. And if we have a loss, the loss is equal to the book value when we retire an asset. Okay. Now we're going to get into the new material today. Do you want me to close the door, babe? Now we're going to get into the new material today, where we had talked about that conceptually we are going to need to understand how this is on page 587 and 588. This is where the revaluation for long-term assets that is allowable under IFRS. Under US GAAP, we report long-term assets at book value. Now, how do we define book value?
I don't know if it's just me, but like it keeps glitching.
Oh,
Is that the same for anybody else?
Is that for everybody else? Am I glitching?
No.
No. Okay, so maybe it be on your end. We do have rain here, but it's not a crazy storm. So I don't usually have internet problems in, just this kind of rain that we're having. So was that Ashley that said that? Ashley, you're the one having trouble with glitching? Or Aaron?
No, I think it was Taylor.
Taylor, sorry. Taylor, you're glitching? Okay, who was the one that said they were having glitching problems?
Taylor, I think she's
Taylor,
stuck.
okay, so she must be stuck and having glitching problems now. Taylor, you having glitching problems?
Yeah, I think I might have figured it out.
Okay, cool. All right, so I just want to make sure that if it's on my end, of course, it affects everybody. And I'm actually in the room. The reason I've chosen my husband's hobby room is because that's where I guess you call it a modem still, is. I'm right where the connection is. So it's the strongest bandwidth spot in the house. Okay, so let's look at page 587 and page 588. And it goes through an example of when the fair market value is different than the book value. IFRS companies can choose, they don't have to, but they can choose to revalue their property, plant, and equipment at fair value. Now, once they've made this election, because of consistency, they can't just change it at will. Oh, this year our property, plant, and equipment is, the fair value is lower than the book value, so I'm not going to revalue. They can't cherry pick is what we call it, cherry picking by doing it only in the good years. Now, they don't have to do it every year, but they need to be consistent with when they do revalue their property, plant, and equipment. Now, the calculations I'm not going to ask you to do the calculations on it, but some conceptual concepts. The conceptual part of revaluation that I do want you understanding is that when the fair value of the property, plant, and equipment is higher than the book value, then the company is going to have, and notice that I'm putting in quotes, a gain. We call it a paper gain because on paper it has, they have a gain. Paper gain is also the same thing as unrealized. And the reason that it's a paper gain or an unrealized gain is because they haven't actually sold the assets. When they actually sell the assets is when you have the realized gain. okay? So I want you to notice they started the calculations on page 587, and it ended up that there was a $4,000 increase. The fair value was $4,000 higher than the book value, okay? So if you look at the journal entry on page 588, at the top of page 588, you will notice that the $4,000 went into an account called revaluation surplus. Revaluation surplus. But what does it have after revaluation surplus? It has dash what?
OCI.
Good, dash OCI. Now, do you remember back from chapter 1 and chapter 4, what is OCI?
Other comprehensive income.
Good, other comprehensive income. And where is other comprehensive income reported? Where is other comprehensive income reported?
Liability.
I'm sorry, Ms. Pham, I didn't understand you.
Liability.
I didn't understand you, but it's reported on the income statement?
Mm.
Okay, so OCI is reported either on the, depending on what form you use, I don't know if you remember in chapter 4, that you can do an income statement or you can do a statement of comprehensive income. But OCI, whether you remember that or not, that's not being tested on here. I'm going to use the board. OCI, if you remember, oh, I'm in shorts today. Sorry, I hope my shorts aren't showing. But OCI is, we have net income. Can y'all see that? Okay, I see the glare of the lamp here. And then let me fix this light so you've got more lighting. There we go. So we have net income. Obviously, that is, you know, the bottom number on the income statement. And then we had plus or minus OCI. And the result is comprehensive income. The result is comprehensive income. And remember that net income is closed into retained earnings. And remember, revenues and expenses and gains and losses are closed into retained earnings. OCI, who remembers what OCI is closed into? It's one of the components of stockholders' equity that we learned. Right.
At the end, it like accumulated other income, something like that.
Exactly, Tanisha, great job. It is in AOCI, accumulated other comprehensive income. Accumulated other comprehensive income. So the reason for reminding you about the relationship of net income and OCI with comprehensive income is that OCI, other comprehensive income, does not affect net income, does not affect net income. And remember, a lot of our profitability metrics are based on net income, are based on net income. For example, you remember calculating earnings per share. The numerator was net income, not total comprehensive income. So we see that when the fair value of property, plant, and equipment is greater than the book value, then that surplus or the gain is reported in OCI. it does not affect net income. It does not affect net income because it is reported as OCI. Now, the second problem, they were using the same company, and the same company in year one had $4,000 surplus. And that $4,000 went into revaluation surplus, OCI. Well, then the second year, the company values their property, plant, and equipment, and there is a $6,000 difference between book value and fair value, but the book value is higher than the fair value. So now they're going to have to write down their property, plant, and equipment. Okay? Look at the journal entry. And again, you're not going to have to do the journal entry, but I want you, understanding the concept that any revaluation surpluses go into OCI. Now let's take a look at what happens when we have a decrease where the book value is higher than the fair value. So we need to write it down. Okay. Notice, and in this problem, in this example, there was a $6,000 difference. Look at the journal entry that was done. They debited that revaluation surplus for $4,000, and then they debited the revaluation expense for $2,000, which sums up to the $6,000. So when you write down your, when the book value is higher than the fair value, and you have to write down your property, plant, and equipment, you can first debit revaluation surplus until the balance is zero. Until the balance is zero. Then the remainder of it goes into an expense, revaluation expense, once revaluation surplus is gotten to zero. Now, the thing that's interesting about this is our surpluses, when we had a gain, because the fair value was higher than the book value, it went into OCI. But if we have a write-down, then revaluation expense is debited to the point that I don't have any revaluation surplus to offset. And revaluation expense does affect net income. Does affect net income. It's reported as an expense, in your operating expenses, and does affect net income. So here we see, again, it's conservative accounting coming into play here. We see this quite a bit, where surpluses go into OCI. It does not affect net income. Any write-downs do affect net income. That revaluation expense does reduce net income. So some very interesting, because of that concept of conservatism, we see, driving this decision, this, IFRS rule. Okay, so that's the big thing that I want you understanding is one. Of course, only companies under IFRS can revalue their property, plant, and equipment. Surpluses go into OCI, which means it does not affect net income. Any write-downs, if the fair value is lower than the book value, does affect net income with that revaluation expense. Now remember, companies can offset their revaluation surplus. Anytime they have a write-down, they can debit revaluation surplus, but only to the extent that it gets it to zero. As we saw in this example, they could only debit it for $4,000 because they only had $4,000 in revaluation surplus. Any questions about that concept? Okay. Are you glad you don't have to number crunch it? Anybody look at the journal, the number crunching, where you've got fair value over book value as your ratio and how it affects, anyway, doesn't matter. We're not going to learn the calculations of it, but the concept of it. Any questions? Right now, I want to be sure and mention, I know you read it, but I want to make sure that you understand that when we depreciate property, plant, and equipment. So anytime we have depreciation, we debit depreciation expense, we credit this contra asset account called accumulated depreciation. Now, when we amortize intangible assets or we deplete natural resources, we would debit amortization expense, we would debit depletion expense, but what account do we credit? You can see the natural resources one on page 589, and the intangible assets on 592. What account do you see them crediting? Is there an account called accumulated depletion or accumulated amortization?
They credit the asset.
Good, they credit the asset itself. Okay, just a difference in accounting, but they credit the asset itself. There is no related contra asset account. Okay. What method is typically used for amortizing intangibles? Which method of amortization is typically used? Straight line? Okay, straight line is typically used. What is typically used when we deplete natural resources?
Activity-based.
Good, the activity-based. And that makes sense because if, I bought a coal mine and the geologist said that I was going to be able to extract, 100,000 tons of coal, then you can, calculate what your cost per ton of coal is, and then however many tons you extracted, multiply it by that cost per ton. And so it just is intuitive sense that you would use the activity-based, okay, method on those two. Now I want to get into, those are just some couple of simple concepts. Now I want to get into impairment. I believe on Tuesday that we covered changes in estimates, and we worked problems on that where you calculate the book value as of the date of change and then recalculate using the new assumptions. I know we did. I remember doing problems with that. So that change in estimates is on page 596. All right, impairment begins on page 600. And with impairment rules, there are two types of impairment rules. One, if you look on page 600, is the impairment of, it's at the bottom of page 600 in the textbook. It may be 601 in the e-text because it's at the very bottom. But property, plant, and equipment and finite intangible assets is one set of rules. Now, what is common about what do property, plant, and equipment and finite intangible assets have in common? And let's look at the second type. The second type is on page 604, and it is indefinite life intangible assets. So we have impairment rules that apply to PP&E and to intangible assets with a finite life is one set of rules. The second set of rules is on indefinite intangible assets. So what is the characteristic that separates the two? Why do we have two sets of rules? So what is common about property, plant, and equipment and finite intangible assets?
They have a definite life.
Okay, good. They have a definite life. Property, plant, and equipment has a definite life, and obviously your finite or definite life intangible assets do. So Tanisha, because of that, what do we do to them? What's happening every year to these asset types?
They depreciate or amortize.
Very
Yeah.
good. Very good. Good critical thinking on that. Property, plant, and equipment is depreciated every year, so my book value is going down. Finite intangible assets, as Tanisha said, are amortized each year, so their book value is decreasing every year. Intangible assets with an indefinite life are not amortized, so their book value is staying the same every year. So that is why we have two sets of rules. One of them, the book value is decreasing every year because of depreciation or amortization, whereas indefinite life intangibles such as goodwill and trademarks are not amortized. So we don't have a decrease in that book value every year. Now that's important because if the book value is going down every year, then you don't have as much of an exposure of your fair value being below your book value in the first group because the book value is going down every year. Okay. So let's first look at the first group, the property, plant, and equipment, and the finite life intangible assets. Those where our book value is going down every year. And with respect to these impairments, it's a two-step process. It's a two-step impairment test that needs to be done to determine, do we need to record an impairment loss? And in the first one, step one is a recoverability test. Step one is a recoverability test. And what is that recoverability test? What do we have to do? Come on, this is the last day of class. Show me how much you know and how prepared for class you are. So what is the recoverability test?
You have to see, sorry, you have to see if the amount of cash flows is less than the book value.
Okay, and what about the cash flows? What's the adjective that you're going to put in front of the cash flows? What do we first?
Undiscounted estimate.
Very good, Afia. That's very good. The recoverability test is we first look at the undiscounted cash flows. The undiscounted cash flows. And if the undiscounted cash flows is lower than the book value, then you have to move on to step 2. Okay? Because if the undiscounted cash flows is lower than your book value, then there's an indication that there is a problem with impairment. Step 2 is determining the impairment loss itself. And again, this is on page 601. So if we fail the step 1, the recoverability test, in that the undiscounted cash flows is lower than my book value, then step 2 is, do I have an impairment loss? And you compare the book value to the discounted cash flows. And the difference is your impairment loss. There's an example at the top of page 602 that you can look at pretty quickly, where it gives you the fair value was 135 million. And so the fair value was 135 million. The book value was 170 million. So they had an impairment loss of 35 million. One of the things that I want you to notice is that in the journal entry, yes, they debited impairment loss for the 35 million, but they debited accumulated depreciation for the total amount of the accumulated depreciation. In other words, you debit accumulated depreciation to get it to zero. So on this example, accumulated, if you see how they calculated the book value, they had cost of 300 million, accumulated depreciation of 130 million. So you see that accumulated depreciation was debited for the whole 130 million. And then the asset was credited for the sum of the two. What I would like for you to do is to tell me what would be on this particular example. Oh, I know I brought my calculator in here. Oh, here it is. What would be in the general ledger after I did the journal entry that you see on page 602? What would be in the general ledger with respect to cost on this asset? So what would be the cost of this asset? So if I were to calculate accumulated depreciation after I have done this journal entry, and I were to write, and I'm calculating book value, I were to write cost minus accumulated depreciation, what would my cost be of this asset? Well, what was the cost of the asset before I did the journal entry?
300.
300, good. And in the journal entry, what did I do to the cost?
You reduced it to the fair value.
Good, I credited it for 165, right? We credited it for 165. So if it was 300 million and I credited it for 165 million, just as Aaron said, 300 minus 165 gives you, as Aaron said, 135 million. 300 minus 165 is 135. Well, what is the 135?
Fair
Aaron? Good, the fair value. And then accumulated depreciation would be what?
0.
Zero. Okay, it would be 0 because you had debited accumulated depreciation for the full amount. So we would have costs now of 135, accumulated depreciation of 0, so that in our general ledger, the asset, the book value of the asset is equal to the fair value. Now, you're not going to have to do the calculations on this, but we're accountants now. We're at the last day of class in intermediate. We started out as bookkeepers and now we're accountants. So if I've changed now the book value, what else am I going to have to change going forward? What happens to this asset every year?
It's depreciated.
Nice job. It's depreciated every year. So don't forget that you would have to change your depreciation just like you would do when you have a change in estimate. You know, now my cost is 135 million, not 300 million. And so you would have to change your depreciation just like you would do using the method of a change in an asset. You know, so think all the way through the impact, because we're accountants now, not just bookkeepers. Congratulations. Okay. All right, so look on page 603. On page 603 is your green, your global, where it explains the difference between US GAAP and IFRS. Notice that under the IFRS, do we have a recoverability step? Is there a step 1?
No.
No. Okay, Taylor, I saw you shaking your head. Right? So, and everybody else, they don't want me to see them on the last day of class, and then you're breaking my hearts because you know how much I enjoy seeing y'all. It's just, I don't know. I just, you know how I feel about my students. So under IFRS, we do not have a recoverability test. Read. So when to test, there's certain qualitative events that will make us where we have to test. Let me ask y'all this question right now. COVID-19, what's happened to our economy? Come on, what's happened to our economy? Talk up. Sarah, what's happened to our economy? Sarah? Liam?
Economy tanked, down 4.8%.
Good. And what are we expecting Q2?
Pretty bad results as well.
Right, pretty bad, right? So our macroeconomic factors right now are horrendous. What do you think that companies right now are going to have to be testing for impairment this year? They don't have to test for it every year. Well, under IFRS, they do. They have to test for the second one every year. But under US GAAP, they don't. There are only certain triggers that say that a company has to test for impairment. Companies right now, I told you, my son-in-law works for a publicly traded company, and he's not the CFO, but he's not too many steps below the CFO. He's in corporate headquarters. And they are, oh my gosh, with impairment testing, you know, with the macroeconomic factors that we have going on right now with our economy just in Q2, quarter 2, oh, it's even going to be worse, as Liam said. They're going to have to be testing for impairment. A big thing going on with companies right now. They're also going to have to assess, remember way back, I think it was chapter 7, where we looked at the allowance for uncollectible accounts. Or they're going to have to be looking at their allowance for uncollectible accounts, because do you think that those percentages that we had for each of the categories, do you think they're going to have to be reassessing those percentages of uncollectability given our macroeconomic factors? So COVID-19 is accounting wise, which is the least of our problems, right? Accounting wise, just we need to get the economy going just for living, but impacting that allowance for uncollectible accounts and certainly these impairment rules. So let's look at the difference again between the two. So recoverability. Look under IFRS on page 603. Good morning, Katone.
Good morning.
That there is no recoverability test. Now, I'm going to read to you, and I know you can read yourself, but an impairment loss is required. Under IFRS, they use this terminology, recoverable amount. And what is the recoverable amount? How do they define recoverable amount? It's the higher of what two numbers? This is on page 603.
The assets value in use and the fair value less the cost.
Okay, good. So the recoverable amount, the terminology used in IFRS, is the higher of the asset's value in use or its fair value. Or its fair value less cost to sell, as Katone said. Now, what is value in use? What does value in use mean? What does value in use mean?
How much it's worth while you own it.
Well, they define it more
what's it?
specifically than that. Read the last sentence.
The present value of estimated future cash flows.
Good, it's the present value of future cash flows. Okay, now look under the recoverability under US GAAP. So we know that an impairment loss is required when the undiscounted amount is less than the book value, right? And the measurement is the impairment loss is the difference between the fair value and the book value. They don't really define fair value, but typically fair value is the discounted future cash flows. The discounted future cash flows. So what the US is just calling the fair value, which one of the ways of calculating fair value and what's used here is discounted future cash flows. IFRS calls the asset's value in use. So the asset's value in use is their discounted future cash flows. They compare that to the fair value, less cost to sell, and the recoverable amount, is it the higher of the two or the lower of the two?
Higher of the two.
Good, the higher of the two. So you've got your your discounted cash flows, you got your fair value less cost to sell. You pick the higher of the two, that's the recoverable amount, and you compare it to the book value. If you look under measurement, the impairment loss is the amount of the recoverable amount less of how much it is less than the book value. So we see some differences here. One is there is no recoverability test. you can, under IFRS, you compare the book value to the recoverable amount. And the recoverable amount is defined as the higher of the asset's value in use or its fair value minus cost to sell. So let's look at a quick exercise or problem. It's exercise 1122. So exercise 1122 on page 625. So take a look at that one and go ahead and work it. I'm not going to work it with you. You should be able to apply what we had just talked about. I'm sorry. Wait, 1122 is about revaluation, not impairment. Sorry about that. You see, it's revaluation. We're not doing calculations on revaluation. Sorry about that. Look at 1127 and 1128. 1127 and 1128. Sorry about that. So 1127 and 28 is on page 626. So 1127 is US GAAP, 1128 is IFRS. So do 1127 first and let's discuss it, and then we'll do 1128. And since it's a rainy day and let's do 1127 and 1129. You're working on 1127, so work on 1127. Instead of 1128, we're going to do 1129. So continue working 1127. While y'all are working on 1127, I'm going to go fill up my water glass. Be right back. All right, so have y'all finished 1127? I can't see all the faces to see if you're still working or not. Tanisha, you finished 1127, still working on it?
I'm finished.
You're finished with it? Ashley?
I finished.
Okay, and Lily?
Finished.
Okay, so let's take a look at 1127. Requirement number 1, what was your impairment loss?
-3. So
Right, 3 million, exactly. So your impairment loss is 3 million. Requirement number 2, where they changed the numbers. What is requirement number 2? What was your answer?
There is no impairment loss
Good, there is no impairment loss. Nicole, why?
because the change in the estimated undiscounted cash flows is greater than the book value.
Good, so it passed the recoverability test, so you did not need to go on to step 2. Okay, does anybody have any questions about that? All right, now look at 1129. 1129 is also on page 626. Daniel, how you doing this morning? I don't think I've heard your voice.
I'm doing well. How are you?
Well, I'm doing well, thank you. Worrying about my mom. You know, my mom had cancer surgery 2 days ago, and it's just, and she's in the hospital, and nobody can go there, so she's by herself. And,
Mhm. How is she doing though? Is she okay?
yeah, I talked to her yesterday. I mean, she's in a lot of pain. It's colon cancer, and she's in a lot of pain, but hopefully the outcome, you know, we're of course anxious to get the pathology reports back to, I mean, we know she had cancer, but to make sure that they were able to get a sufficient margin so that they were able to remove it all.
Yeah.
So you know, and it's hard when you want to be there, you know,
Of course.
you
Where
can't.
does she live?
In Baton Rouge. But I would have, you know, flown in, you know, to, you know, flown back if we were in class. Of course, right now I could do it online, but I would have at least, but anyway, it's tough. So in requirement 1, what did we get as our impairment loss? And this is under IFRS.
70 million.
Good, 70 million. 70 million. The reason that I chose 1129 instead of 1128 is because you had to apply that definition of the recoverable amount. It gave you both the present value of the cash flows and then the fair value. So you had to figure out what is the recoverable amount. And it's the higher of those two numbers. The present value of your future cash flows, which is the value in use of that asset. And did the undiscounted amount that they gave you, did you use that at all? No, because there is no recoverable amount. So if you didn't get the 70 million, your hand ought to be going up about how that was calculated, okay? Now, requirement number 2, what was the impairment loss?
75 million.
Very good, 75 million. Okay, 75 million. So is everybody good with the impairment on the first type of the asset? We have a 2-step impairment process under US GAAP. Under IFRS, there is no recoverability.
For IFRS, would we put it as a negative?
Yeah, they're always, you're talking about in Connect?
No, not in Connect. Well, for the exam.
Yeah, you follow the instructions because like in the beginning of class, I think it might have been a few minutes before 8 o'clock.
No, I heard it.
Oh, you heard me? Okay, yeah. Where in Connect, it wants you to put that minus in the
negative,
because it's a write down, right? We know, you know, that we would be debiting impairment loss because a loss is like an expense, and to increase it, we debit it. Okay, so you just have to, in Connect, you would just have to read the instructions as to whether they just want you putting 70 or the minus 70. I know in the homework, it wanted you putting the minus 70. Now,
yeah.
If you're on the exam, I'm going to do this exam just like I did the second exam, and I'm going to look at every question for every student. So like if you put 70 million and it counted it wrong because you didn't put the negative in front of it, then I'm going to give you the points back because that was just a Connect.
Right, yeah.
So don't, yeah, I mean, follow the instructions because then that's the less I have to go back and adjust. But if you put 70 and you got the right number, you just didn't put the negative, I'm giving you the points back. So again, trust me, I promise y'all, this isn't lip service. I look at every question for every student to look for things like that, okay? Because I don't want you losing points when you got the concept right just because you didn't put the negative in front of it. That's craziness, you know. Okay, so that is the impairment for assets that are either depreciated or amortized. Now let's look at the impairment for indefinite intangible assets, which is on page 604. And we know that goodwill and trademarks are the ones that we typically think of. They're more than that, but goodwill is a big one. And then your trademarks, because remember, we can keep renewing trademarks into perpetuity. So it is considered to be an indefinite life intangible asset. And there's just a one-step process. Look at page 607. Look at page 607. And 607 summarizes that obviously goodwill is an inseparable part of a group. Like, if it's a big company that bought, another company, that may be just a division of the company. They call it a reporting unit in the United States. They call it a cash generating unit under IFRS. But it's way to seeing what unit that goodwill is associated with when you bought the goodwill, what division of the company that goodwill is associated with. And we know that it's an inseparable part of a unit. So you're going to be comparing the fair value, the basic concept. You're just going to be comparing the fair value of the unit to the book value of the unit. Now, one of the things that is different about the two is that under US GAAP, of course, we're comparing the fair value to the book value. And if the fair value is lower than the book value, then we've got an impairment loss. Under US GAAP, remember, goodwill is part of a unit that has property, plant, and equipment. So under US GAAP, you first look to see if the assets or long-term assets of that unit are impaired, and then do goodwill. Okay, so first look to see if other assets in the unit are impaired, and then look to see if goodwill is impaired, because now if you had, property, plant, and equipment that was impaired and you wrote it down, now your book value of the unit is lower. Under IFRS, you do goodwill first and then the other assets, okay? You can see that the measurement, compare the recoverable amount. We know how to define recoverable amount. And if the recoverable amount is less, reduce goodwill first, then the other assets, okay? So reduce goodwill first, then the other assets. So actually this one is easier to do. You can see that under IFRS, that this has to be done annually under IFRS. They don't have it there, but where you read about the two, it has to be done annually under IFRS. Now I want you to look at on page 608. They've given you some information on 608 where you've got the fair value of a company, you've got the fair value of the net assets excluding goodwill, the book value of net assets including goodwill, and then you've got the value in use, which is, remember, the present value of the future cash flows. And under US GAAP, the fair value is 132 million. The book value is 150 million. So you have an impairment loss of 18 million. Now under IFRS, remember, we're going to compare that 150 book value to the recoverable amount. And the recoverable amount is the higher of the value in use, or the fair value minus cost to sell. So what is the fair value? What is the fair value of the unit?
$132.
Good, 132. So the fair value of the unit is 132. What is its value in use?
35.
Good, 135. So what is the recoverable amount under IFRS?
35.
Good, the 135. Remember, it's the higher of the two, just like you did in exercise 29. So the impairment loss would be 15. We see a difference in impairment loss between the two. Okay, so that's your impairment under the 4 methods, the 2, and then IFRS and US GAAP under the first one, and then IFRS and US GAAP under the second one. Any questions about the impairment? All right, and then don't forget the journal entry. Debit that impairment loss, debit accumulated depreciation to get it to 0, and then credit the asset for the sum of those two. Now in 611, it talks about subsequent expenditures. This is, we have assets, and what if we incur cost related to those assets subsequent to the purchase of it? How do we know what cost should be capitalized and what cost should be expensed? And what costs should be expensed? If you look on page 611, you see 1, 2, 3, the basic, the rules, of how do we know whether this asset should be capitalized or not? And of course, we know that assets are something that give us future benefits. Future benefits are what an asset is. So if we incur cost that is going to increase the future benefit of an asset, we will capitalize that cost. So you can see that a future benefit means, does it extend the life of the asset? I have a truck and I expected, the truck to last 5 years, and it's 5 years and the truck is not running like it should be, very inefficient. So I have a choice of buying a new truck, or to make the truck last longer, I can replace the engine. And if I replace the engine, I'll get 3 more years of life out of it. So that engine would be capitalized instead of expensed as repairs and maintenance expense. Now, if I were just changing the tires or changing oil, that's just normal routine maintenance. So we would expense that. The other thing is, the second one is if it increases the operating efficiency of the asset. I've got a piece of equipment that's producing, that's in my manufacturing, and it just needs some major new parts on it that then will increase the number of units that it can produce, increasing operating efficiency. Or it increases the quality of the goods or services that are produced. Those are the 3 things that if they do one of those 3 things, then you capitalize the cost instead of expensing it as repairs and maintenance. Now, one of the things that comes into play here is materiality. You look at a big company, look at UPS. They've got a lot of brown trucks that are driving around. And the cost of replacing an engine is probably not material to, you know, a $3,000 engine is an immaterial amount to UPS given the size of the company. So they may expense that, although the gap concept says to capitalize it, they may expense it because it's immaterial. Okay, so we do see materiality coming into play here. That concept, it's like supplies. You know, remember we talked about office supplies, how the guidelines, the gap says that we capitalize office supplies, but how many times do we look at the balance sheet of a big company and see office supplies as a current asset? We don't, because it's immaterial. You know, who cares about the number of paper clips and cases of paper that UPS has? So this is another example of where materiality comes in, that although it may meet the definition that it needs to be capitalized, companies will expense it if the cost is immaterial. Okay, so that's what that is. Now, as far as they had in here composite depreciation, depreciating by groups. We're not going to cover that. Didn't talk about that at all. One of the interesting things, and I just think it's on page 613, and you know, sometimes I wonder how you know, these brilliant financial people and accountants are sitting in a room and they come up with these crazy rules. But there's a rule on page 613, cost of defending an intangible right. So we have a patent and we think somebody has infringed on our patent. So we sue them, we take them to court for patent infringement. This is just one of those rules that I don't know why, I just think it's just so funny that somebody would think of this rule. But the rule is that if you successfully defend, like you win the case, then you capitalize the cost, all the attorney fees and all that you incurred, you would capitalize those costs into the patent. You would debit the patent and credit cash for paying all the attorneys. If you lose the case, you don't successfully defend your patent, then you expense the cost. I don't know, I just think they come up with some silliness and some rules one time, and we've got a busy life and we have to wait to see if we need to capitalize all these costs or expense all these costs, depending on whether we win the case or not. But that's what the bottom of page 613 is, and it's just one of those accounting rules that I just think is a silly accounting rule, but it's there. So now it's your turn. Questions, you know, and this can be questions on anything on your topical coverage that we have, chapter 8, 9, 10, or 11. I also, oh, wait, okay. So yes, questions. I want you to be thinking about questions because we've got quite a few minutes in class and I'd like to use every minute of it. Also, so be thinking about what questions you have. Also, I would like to come up with a consensus among you of what time of day. Your exam is on Thursday, right? Thursday at 8:30. So on Wednesday, I'm going to have office hours and it'll be just for your class, not all my students, not even the other intermediate class. I'm going to have office hours on Wednesday just for your class. I don't know your schedule. My principal's class also has an exam on Thursday, and I'm gonna have office hours just for them. But I'm gonna give y'all first pick on what time of day would be better for you to have office hours on that Wednesday. So how many of you, and I see everybody, give me a thumbs up if the afternoon is better than morning. Oh, y'all give me that, not using my reaction. Good, there, I've got thumbs up. So it looks like, oh, go ahead and do, right. All right, so us 1, 2, 3, 4, 5. Okay, how many of you is midday? Okay.
Can we do 2 thumbs up?
Oh yeah, absolutely.
Okay.
Yeah, absolutely. You can do 2. It's not one or the other. I'm just trying to think. All right, so midday. All right, how many of you is morning? All right, so it looks like we got a big choice here that y'all are pretty open on Wednesday.
Yeah.
All right, all right, so let's think about this. Hopefully 99% of your studying is done before Wednesday. So do you want to meet with me earlier in the day so that then you can practice later in the day? Or are you still going to be practicing and want to have your questions for me, you know, say late afternoon? I'm trying to make this best for y'all.
I want to meet you early.
Your morning, Miss Pham?
Yes, morning or midday.
Okay, morning. And so how is like 11 to 1? That kind of gets the morning people and the mid-afternoon. All right, send me a private chat if 11 to 1 you cannot do. So just send me a private chat if 11 to 1 is not good for you. Okay, so looks like 11 to 1 kind of gets that morning, and then it's not too late in the afternoon where you can't, because I don't want y'all staying up all night. Y'all got a quiz, an exam at 8:30 in the morning. So y'all should be completely done with your studying by 6 o'clock. And then you're eating well, relaxing, watching a good movie, and then going to bed and resting. All right, so I will set it up for 11 to 1 on Wednesday. And I will send out the link. All right, for that. Now, I got a problem. On y'all's class, I went ahead and dropped, remember how we dropped the 2 lowest quiz grades? So I've done it for y'all's class. I dropped the 2 lowest quiz grades. And I said there were 7 quizzes. And so that meant that you had 5 left. Well, there were 8 quizzes. And like, I know the grades in the 8th quiz, but of course once I, drop it, that grade is gone. So I don't know what to do with this 8th quiz. I don't, I could look at it and compare it to your other grades and leave it in. But if it's a low grade, then I don't know if it's your lowest grade or not. Now, thankfully, I realized this before I did it on the other intermediate class. There's 8 and dropping 2. But I need to treat both classes the same. So does anybody have a recommendation on how I can fix this problem that I created? You didn't. The only thing.
I get 100.
Go ahead. Oh, give you a hunt. Love it, Liam. Do what now? Let's be reasonable with the.
Would you be able to
Wait,
like
Oh, wait, Catone. Liam, what did you say first? Then Catone, I'll go.
Okay.
Liam?
Oh, I just said we could all get 100.
Oh, I see. Okay, could all get 100. All right. Would be nice.
What if like the points we got on that 8th quiz, could they be added to the final? Like whatever we earned on the 8th quiz, could that be
Well, you're
added
saying
to?
extra, like with the zero denominator
Right.
as extra credit.
Or would that be fair to the other class too?
Well, whatever way I do your class, I'm gonna have to do the other class too. The other thing that I was thinking of is instead of dropping 2 grades, drop 3. And that still leaves you with 5, but you drop the third to lowest. I got to getting thumbs up. So is dropping.
Can it be added to the extra credit we were getting?
Well, the extra credit, I have to remember from a professor's standpoint too, is that I've already got extra credit with participation. And I have to be careful with extra credits as far as grade inflation goes. I know y'all like grade inflation, but grade inflation is not a good thing for any university institution. Grade inflation can actually be quite a problem. Okay, so those are my 2 possibilities. Have drop 3. All right, let me just work with the numbers and see how badly the grade inflation is with doing it as an extra credit, as Catone said, or just dropping 3 quiz grades, and you still have 5 instead of 6 that are counted. Let me look at the grades on that 8th quiz that it was just, anyway, it doesn't matter why it happened, but and see how bad the grade inflation is with doing it as the extra credit. I know that would be your preferred method, but again, I have to be careful about grade inflation. So let me look and see, and so if y'all see y'all's grades kind of changing a little bit, I'm just testing, and then I'll let you know what the final decision is on that. But I did do that, and whatever I do for y'all, I'll have to do for the other class, okay? All right, so questions now about if you've started studying, questions that you have. I haven't finished the exam yet to let you know how many multiple choice and how many problems. In chapter 8, the probability of having a problem where you're calculating, your LIFO, FIFO, perpetual, ending inventory, cost of goods sold, that's a good, that's usually one that's good for a problem instead of multiple choice. So is DVL. In chapter 9, of course, calculating LCM and LCNRV. And I'm not saying, I'm just looking at the ones that are that have a higher probability of being problems instead of multiple choice. And calculating one of the retail methods, either the average retail, conventional retail, LIFO retail, or dollar value LIFO retail. I will say this, the probability of dollar value LIFO retail being a problem is low. That dollar value LIFO retail is more likely going to be multiple choice. So either your average retail, your conventional retail, or your LIFO retail are the 3 that are subject to being problems. Dollar value LIFO retail, as you know, is the more complicated calculation one, so I'll leave that in multiple choice. So I'm going through these quickly so that you can focus on what questions that you want to ask. Interest capitalization. What is the probability of interest capitalization being a problem? Come on. Do you think you're going to have a problem on interest capitalization? Yes, no? Yep, I see shaking heads, but I got several students that aren't showing me their faces. Yes, you are going to have an interest capitalization problem. Okay. You know, remember your decision tree, the specific interest, the specific debt, the other outstanding debt that you have to use if your weighted average, if your WAAE exceeds your specific debt, then you have to, the excess is multiplied by the weighted average interest rate of the other debt. So remember, interest capitalization, there is going to be a problem on that. I can guarantee you on that one. Of course, the others in chapter 10 are more likely to be multiple choice. In chapter 11, doing journal entries for the disposal of long-term assets is a candidate for a problem, as well as calculating impairment. But disposal, you know, whether you sell it, exchange it, or retire it, the journal entries on that, doing the journal entries for disposal is a good candidate for a problem. And then the rest would be in multiple choice. So how are y'all doing with the concepts on these two chapters with inventory, initial measure of inventory in chapter 8, subsequent measure of inventory in chapter 9, and then long-term assets in 10 and 11? Tanisha, you ready to take the exam today? Almost.
Like today.
Not today,
Yeah,
but
kind
soon,
of.
huh?
We're getting there.
Good, you're getting there. I hope that y'all have all been studying as y'all have got till Thursday. Please, please do not, if you wait until Wednesday, although it's open book, open notes, because it's an, online at-home exam, if you don't know it, then you're not going to have time to finish the exam. So please don't wait, be studying, have a goal, set a schedule of, I'm going to have chapter 8 completely studied by this date, chapter 9, chapter 10. Then take a break, have a day where you take a break, and then go back and work some practice problems at the end of the chapter, or some that I've uploaded, and practice them and see if you can do them without referring to your notes in your book. I know you're going to have your notes in your book available, but if you're having to rely on it too much, you're not going to have time to finish the exam.
About how many questions do you think will be?
That's where I'm in the middle of doing the exam right now, and please do not write this in granite, and I will I work on it. But right now I'm targeting having 5 multiple choice questions from each chapter, which would be a total of 20 multiple choice. And then I've already shouted out examples of problems that you can have. You're going to have at least one problem from each chapter. There may be a chapter that you've got 2 problems from. So I would say between 4 and 6 problems, no more than 6 problems. There's not going to be 8, like 2 from each chapter, because you won't have time to do it, because interest capitalization takes a while. And so I understand the time constraints. So Taylor, that's about where I am, is 20 multiple choice and 4 to 5 problems.
Okay, thank you.
You're quite welcome. Okay. So if you don't have any, be happy to answer. We got 20 minutes left in class. Is there an area that you would like to work a problem on? Or do you want to wait and study some more? All right, so I'm going to be grading your AS2. I want to, by Thursday, have everything graded except for your final exam, obviously your final exam. So that's my goal, is I'm going to be doing a lot of grading because y'all had AS2, and then my principals had an ethics assignment and the financial statement analysis project. So I'm going to want to have grades done so that in the final, going into the final exam, you know where you are. I'm going to caution you. I have seen in the 20 years that I've been teaching, next year is my 20th anniversary at UT, but in the 20 years that I've been teaching, I have seen, and I did it as a student too, where students will calculate, I need X grade in order to, I need an X grade on the exam in order for me to get this letter grade. And so they study to get that number. Well, you need to leave some variance in there because you may undershoot. You may say, okay, I need a 70 on the final exam. And so you shoot, you study at a 70% level, but then you get a 65. And that sucks. And I've seen it so many times. So don't shoot average, shoot high. Shoot high. Okay. And the participation grades and the extra credit grades, you will not see posted on Blackboard. I've got those numbers, but Blackboard is the weighted average. So I need to download y'all's grades from Blackboard, obviously into Excel. And then I will add the extra credit in a column within Excel. It's too difficult for me to do it with anyway, but just, I am an honest person. I take your final grades very, very seriously. I spend a lot of time looking at them. Remember, we've also talked about points on the table. Do you remember those? Where, if there were questions missed, like on exam one's the only one that we had in class, and too many students missed it, but there's no reason that y'all should have missed it because the concept was covered. And I said it was points on the table. So I look at the points on the table. I look at your body of work that you have done in the class. And there are also natural breaks that happen when I download grades and then I do a data sort, in descending order. I don't know the grade scale, but say an 82 is a BC. Say there's an 82, and then the next grade is a 79, which is also a BC. And I don't know if that's the case or not because I don't memorize the grade scale. Well, then the 82 would be pushed up to a B because you see there's a natural break there. And it happens every year. It happens every year. Now, a C, a 70 on the grade scale, does anybody have their syllabus in front of them? A 70 is what on the regular grade scale? Is it a CD? A 70%? I think it's a CD. The syllabus are in the other room.
It is.
Okay, I thought so. So a 70 is a CD. Thank you, Ashley. A 70 is a CD. I understand that you have to have a C or better in order to move on to 420 accounting majors, in order to move on to 420. So those grades that are hovering around that CD, range that are in the higher part of the CD range, I look at very carefully. Rarely, I'll just make this blank statement. If you got a 70%, you will get a C, not a CD. Now, the question is, what happens with 69s and 68s? That's where that natural break and looking at your body of work comes in as to whether they get pushed up or not. But a 70, I promise you, will be a C, not a CD. Okay? Any other questions that you have for me? This is our last day of talking to one another. I love this class. I enjoy sharing intermediate accounting with you. I know I push you. I need to push you so that your critical thinking skills, I hope that you can reflect on where you started the beginning of the semester at with memorization, memorizing journal entries and adjusting journal entries, so that now you can look at an economic activity or a situation, for whatever topic it is on, and apply that critical thinking. Where you can back into, those questions, those critical thinking questions where you have to back into the way to answer it. It's not always the straightforward where we answer that critical thinking. For example, in the second exam, what was gross profit on a long-term construction project? And you don't have any information about what revenue is. But I know gross profit is a debit in CIP. So that type of critical thinking. I hope that you have seen that growth in yourself. You've got to be able to critical think in order to be successful in any business career, in any career, but especially in accounting and finance. So I hope that you have seen that growth. I know that while I'm pushing you and you're seeing it as difficult or hard to do, that you appreciate it at least later. You might not appreciate it right now, but I hope that you appreciate it as you go through your accounting classes, coming up, your cost, your audit, your intermediate 2, that you've already changed and you have improved your critical thinking so that those classes are better. And I hope that I have added that value to your life, especially your accounting life. And I know I push. I know I'm hard, but I do it for a good reason. Obviously, I don't do it just because which one gives pain? A sadistic, or one receives pain and one gives pain, and I'm not into that, but I don't enjoy either one of those, but do it for your benefit. I usually, when my students turn in their final exam, I shake hands. I enjoy shaking hands with all of my students. I don't know if shaking hands is going to be part of our business culture anymore after COVID-19. So maybe we would do an elbow bump at this point. I'm going to miss that. This will be the first semester that I've not shaken my students' hands when they turn in their final exam. And I know that seems silly, but it's an important thing for me to do that. The other thing is that going forward in your accounting classes, you know where my office is. Please stop by and say hello and let me know how you're doing. And even if you've got accounting questions or just want to sit and chat, please come see me. I care about each and every one of you. A whole lot, actually, more than you really realize. So come see me. My office is 254, in case you forgot, since we're all at home.
I've been on campus in so long.
I know, did you? Right. I'm
I
looking
like
forward to
drove
being back.
past. It's a ghost town.
Oh, you've been by campus?
And no, like there's no one on there.
Well, no,
So
I'm
completely
not
empty.
allowed to go in my own. I can't go to. I'm not allowed to go to campus. I can't go to my own office.
Miss it.
I do too. I miss it quite a bit. And I'm looking forward in the fall. And since I didn't see y'all this whole second half of the semester, please come by and see me. Please come by and see me. Whether it's an accounting question or just to say hi, either way, okay? I try not to be too busy for my accounting students when you just drop by to say hello, okay? All right, so I will see y'all on Wednesday between 11 and 1. In the meantime, if you've got a specific question about a problem that you're just stuck on, email me. And I can set up a Zoom meeting, okay? So just email me and I can set up an individual Zoom meeting, before Wednesday. Be happy to do that. I've enjoyed y'all. I'm getting all sappy right now because I haven't seen y'all. And sometimes I'm a hugger also, so I miss y'all. So good luck on studying this weekend. And I will, see y'all between 11 and 1 on Wednesday. Again, it's not mandatory and you can come and go as you please. You can come in for 30 minutes or stay the whole 2 hours to see what other questions somebody are doing. If you're ready for the exam and don't need it, then I won't see you on that day. All righty. And if you need additional practice problems on any particular topic, let me know and I will write one. Okay. I know I've got one up for interest capitalization. But look, there's end of chapter ones also, but if you need a problem, I can, I'll be happy to write one. Okay. All righty. Really enjoyed it and see y'all on Wednesday.
Thank you.
You're welcome.
Thank you.
You're quite welcome. See
Thank
each other. You're welcome. Bye-bye.
Bye.
Bye-bye. Oh, I'm gonna cry. Bye. I gotta get off.